Okay, so I think we'll get things started. So once again, hello and welcome. Good morning or good afternoon, and thanks for joining us today on our webinar where we're going to speak about the offshore EPC contracting, where we're going to take a look back at the first half of the year and then have a look forward as well. It's been a little while since we've done a webinar covering these topics, so I'm really pleased to be able to introduce you to what's coming up. So if we can move on 2 slides, please, Ben. Usual disclaimer before we move on. Thank you. So just before I introduce my colleagues, bit of housekeeping for you. So bottom of your screen, you'll see a Q&A button. Please feel free to use that during the session. If there's anything the team can respond and answer in line, we'll do so. If not, we'll take those questions and go through them at the end of the presentation. Before I hand over to Ben, who's going to start things off, just a quick introduction. I've just introduced myself. We've got Mark Adeosun, who's Research Director covering SubseaLogix and PlatformLogix. Ben, who's our Senior Analyst. And Alex Axelberg, who I can see some clients on the line, many of you know as a BDM. Ben's going to go first. He'll hand over to Mark. We'll have the short Q&A. And then for anyone that wants to stay on and have a look at some of the data behind what we're going to present today, so we can explain how we generate our analysis from our own applications, there'll be a short 10-minute session at the end. So I think running time from now, we'll probably aim to finish at 4 p.m. UK time, or indeed 55 minutes from wherever you are.
Thank you. So just say from the start, we don't actually forecast demand. Instead, we take a range of views from market players, including BP, the IEA, and OPEC, and use an average of these sources to provide scope of where demand could fall over the rest of the decade. In the short term, so 2024 to 2025, we take an average of the IEA and OPEC's monthly reports for our demand outlook. And when we look at this year, they are 2 very divergent sources. So OPEC currently predicts growth of about 2.2 million barrels on 2023, while the IEA predicts growth of about 1 million barrel per day. So what do we expect for the rest of this year and for the rest of this decade? For 2024, we expect supply to be well under demand throughout, with undersupply of around 1.8 million barrels per day. The 2.2 million barrel per day voluntary cuts from several OPEC Plus members, along with the wider group's ongoing output restriction, have really been absolutely crucial to this undersupply, counterbalancing supply additions from places such as Brazil and the US. In the case where the IEA's demand outlook ends up being more accurate by the end of the year, so that was that 1 million barrel per day growth, that large undersupply would be significantly smaller. And I think this is somewhat being borne out with the oil prices. They averaged about $84 in the first half of the year, despite that large disparity between supply and demand. And that's a reflection of concerns over consumption from key places, such as especially China. 2025 is expected to see this undersupply we're expecting for this year really start shrinking quite dramatically. And that's, again, down to OPEC Plus, saying that from September of this year, they're going to begin to start adding those voluntary cut barrels back into the market. Should they all be added back in within 12 months, as they are currently saying, that is an additional 2.2 million barrels per day of oil supply. When you also factor in non-OPEC supply growth, it's likely to be enough to counterbalance an expected increase in demand of about 1.42 million barrels per day when you take the average of OPEC and IEA. So that works out about 105 million barrels per day of demand. So in line with what we were hearing in the survey. And when we talk about a game of 2 halves, I think for Mark, that analogy really reflects the first half of the year compared to the second. For the liquid supply demand balance, really it's talking about the decade. 2020 to 2025 has seen and is forecast to see demand increases of over 1 million barrels per day every year since 2021. As the market recovered from COVID and abundant demand growth is seen in key markets. There has been plenty of supply, and that's both structural barrels, things like fixed and floating platforms that have long lead times, tend to be quite hard to sort of put on and take off of production, and quick barrels, things like OPEC Plus and US shale, which can come online and be taken off a lot quicker. Post 2025, and especially as we near the end of the decade, this picture really begins to change. Structural supply is expected to still be going up, but demand may not be. Numerous forecasts now see 2030 as being at or already past peak demand for liquids. And as you can see on the chart, that strong growth we see 2021 to 2025 becomes much slower afterwards and is essentially more of a plateau for a lot of the second half of this decade. This presents something of a problem when it comes to balance, given those structural barrel increases that have been sanctioned since 2022 and expected to come online sort of over the next few years. As well as this, OPEC Plus's aforementioned decision to roll back the voluntary cuts and their continued assurance that the overall production quotas could end will really make it a market that looks more likely to be over than undersupplied through the remainder of the forecast. Crucially, that's without any OPEC intervention. This is still a very uncertain market, however. Demand could increase beyond that average view to rest closer to some of the high estimates of the forecast, such as OPEC. And in that case, the question won't be so much as what to do with the extra supply, but what will OPEC Plus members do? Unless there's a significant upwards or downwards change in demand, they still have a very delicate balancing act to maintain. If oil prices go too high, what we've learned is that US shale tends to react quickly and within a year has met that extra demand, while a number of structural barrel increases are also sanctioned, adding to supply further down the line. But if they go too low, the countries of OPEC Plus run the risk of not being able to balance their budget. And within the last 10 years, that has been a significant problem. So it's going to be at the top of their minds. As a result, within reason, we expect that the OPEC Plus group will continue to cut beyond the current date they have confirmed to ensure that oil prices remain in that kind of sweet spot, ideally above $70 a day, but really between about $80 to $100. And all of these things are kind of being factored in when it comes to whether to sanction projects or not. So how will all this kind of impact offshore production over the coming years? I should flag this includes gas as well as oil, but when we look at offshore production on a global scale, there are two clear areas that will dominate when it comes to the supply of new oil and gas production through to 2028. And chiefly that's the GCC and the Americas. Most of which, especially in the early years of the forecast, the projects that are driving these production changes are already sanctioned, and that's a result of those high oil prices, which have caused that kind of flurry of sanctioning we've seen in recent years. As a result, we don't expect a lot of these projects to be delayed in the way that the two Saudi projects were earlier this year. And they could see construction delays and things like that, but actually being shelved and moved to the right, unlikely for that reason. Qatar, where heavy investment is being made into the North Field as feedstock for their LNG expansion, will really lead that offshore production additions over the time period, with 1.3 million barrels of oil equivalent per day of additional production expected by 2028. And Saudi Arabia, despite the delays to increasing its maximum sustainable capacity to 30 million barrels per day that stole the headlines earlier this year, is also expected to see a heavy production addition of 1.2 million barrels of oil equivalent per day as projects that were already underway when that was announced progressed to first production. And other GCC players, such as the UAE, where projects like Belbazan Phase 2, Dawra and Hawan Gasha are sort of already underway, are also seeing major additions to their production over the forecast. When we move away from fixed platform projects in the Middle East, the main supply additions elsewhere will really be coming from FPS projects. And these will be led by the Americas, especially Brazil and Guyana, where a raft of orders in the last few years really starts to support those structural barrel increases I mentioned on the previous slide. And these will be joined by Suriname, which is expected to see the Block 58 FPS project start up at the end of the forecast, as well as Mexico, where 12 fixed and floating projects are due to start up through 2028. And something that I think gets kind of relatively lost in all the noise over the Latin American projects is the fact that 6 FPS projects, 5 of which have already been sanctioned, are expected to be installed over the forecast period in the well-established Deepwater Gulf of Mexico area in the US. And that includes projects like Beacon Offshore Energy, Shenandoah, as well as Shell's Sparta and WOW projects. And I just want to highlight that because their shallow water production is declining quite rapidly, but the deep water production is of such a scale that it's still increasing. When we look outside of those two areas, though, it's clear that most places are seeing flat or declining production over the forecast period. That being said, areas such as West Africa, Southeast Asia, and Europe are expected to see some projects go ahead. It's just that most of them will not be of the same level as the declines coming from existing projects, so there won't be enough to really move the needle. One thing to highlight before I move on is that there are 67 FPS deployments expected over the forecast period of 2024 to 2028. 19 of these units have yet to be sanctioned, with a total oil throughput capacity of 1.1 million barrels per day. 5 of the remaining 48 units, which are at the EPCI or pre-order stage, with a total of 500,000 barrels of oil per day of oil capacity, are scheduled to start up in 2028. So this is where we expect to see the most project delays, those projects that aren't sanctioned or those ones that are due to start up right at the end of the forecast. And should some of them projects move to the right, that delicately balanced supply-demand picture could look very different. So with all this talk of new fixed and floating units, the question is, how will that begin to change the picture for offshore production when it comes to water depths? The truth is, it doesn't massively change things over the forecast, but the slow and gradual kind of change in proportion of production between shallow and deep, which can be seen, especially since sort of 2016, is expected to continue. In 2023, 73% of offshore production came from shallow water, with this dropping to 70% by 2028. The vast majority of shallow water production comes from fixed platform developments, and as mentioned, the GCC is where we'll really see the significant barrel additions over the forecast. And that growth in production in this one small area will mean that the shift to deep water globally is not as pronounced as it would otherwise have been, because of the sheer glut of oil and gas that's being produced and kind of counterbalancing to stagnant or declining production elsewhere. And shallow water production is expected to average about 36 million barrels of oil equivalent per day over the forecast period. In comparison, deep water production, which represented about 27% of offshore production in 2023, is expected to grow at a CAGR of about 6.1% compared to 1.7% for shallow water. Deep water production is forecast to reach about 16.1 million barrels of oil equivalent per day by 2028, and that's up from 12.7 million barrels of oil equivalent per day in 2023. And this will primarily be a result of those aforementioned FPS units entering the market. Overall, though, I think the point to take from these slides is quite clear, is that offshore production, be it shallow or deep, will be vital to meeting the demand needs of the world over the remainder of the decade. And the projects that have been sanctioned since 2022, as well as the upcoming ones that will feature in Mark's slides, will be kind of vital to not only meeting that, but really shaping what OPEC Plus does in the coming years. Now I'll pass over to Mark, who's going to go a bit more in depth onto the current EPC contracting market.
Thank you very much, Ben. So basically, I would like to kick off by talking around the FID counts that we've recorded year to date. Furthermore, a good comparison year on year since 2020 to see the number of FID counts. So overall, what we've seen so far this year is we currently forecast 43 field FIDs for the entirety of 2024. And this is a significant downward revision when you compare that to our forecast at the start of the year. And that is because quite a number of major projects have actually been delayed since the start of this year. A few of those I would mention will be the Pemex's Zama development offshore Mexico. We also have Repsol's Pollock and Chinwol project, also offshore Mexico, whilst Pink Petroleum's Avalon development in offshore UK is also one of those projects that have actually been delayed. Furthermore, if you compare the FID counts we have this year to that of 2020, that is more or less a downward decline of about 10 fields. And you can really start to see that operators are beginning to stay true to their budgetary allocation for 2024, as inflationary pressures is really pushing a lot of project economics. We've also highlighted here on the right-hand side of the map some of the major projects that have been sanctioned in the first half of this year. And I'd like to mention a few based on the unique nature of those projects. I'd like to mention the Whiptail project, which is Exxon offshore Guyana. And that project currently accounted for 44% of the subsea tree counts that we recorded in the first half of this year, which is 48 units. Also, I would like to mention the Atapo Phase 2 and Sepia Phase 2, which is for Petrobras, offshore Brazil. and they accounted for 2 new build FPSOs with an EPC award value for those units to be at about $8.1 billion. I would also like to mention some of the projects that had integrated contracting strategy involved in the FID, and that would include the Energen's Katlan project offshore Israel. We're also looking at the Zena Phase 3 project for Woodside offshore Australia. Another IEPCI project was the Brasse project, which is operated by Okia offshore Norway. So those are some of the unique projects that we've recorded in the first half of this year. And for the remainder of 2024, we currently anticipate another 26 field FIDs to be sanctioned, with Total Energies Block 58 project offshore Suriname being the headline for that one, whilst BP just confirmed this morning that they have taken FID on the Cascada project in the US Gulf of Mexico, which is one of those major projects we're also tracking for 2024. Next slide, please. So overall, when you're looking at the offshore EPC market outlook, what we currently track here would be all of your engineering, procurement, and construction award value for your subsea equipment. That would also include your floating production systems as well as your fixed platforms. So overall, this year, we currently anticipate 61 billion in EPC award value, and we've already recorded about 50% of that in the first half of the year. Obviously, majority of those were led by some of the high-ticketed items like the P84, P85 FPSO unit, as well as the Cedar Air FLNG unit offshore Canada. So despite the fact that you, from the previous slide, you can see a year-on-year decline in FID count, what we anticipate this year is outside inflationary pressures that is making a like-for-like cost of equipment and services increase year-on-year since 2020. We are also seeing operators taking the plunge into high-ticketed items so far this year. Furthermore, you would have certain projects that had their FID passed in 2023, but contract awards were not announced until 2024. So a case in point in that is going to be Shell Sparta project in the US Gulf of Mexico, where Shell actually announced the FID in December 2023. However, EPC contracts for the floating production systems as well as the subsea equipment were not confirmed until Q1 this year as well. So overall, you can see some of the demand outlook that we have for the rest of 2024. So for subsea trees, we're currently looking at 260 subsea tree units, of which we've recorded 110 units awarded in the first half of the year. We're looking at the soft market of about 4,200 kilometers of soft lines to be awarded throughout this year, and we've recorded 1,800 kilometers in the first half of the year. When you look at the export lines, we currently forecast 2,500 kilometers of lines, and we have recorded just 800 kilometers year to date. So overall, if you look at the forecast period 2025 to 2028, we currently anticipate 51 billion of offshore EPC spend despite inflationary pressures. Though we've recorded some delays as well as project cancellations or tender cancellations, we believe that we're beginning to expect spare capacity within the supply chain to be able to accommodate some of the projects that are currently in the pipeline that will be driving FIDs as well as contract awards going forward. I would like to highlight some of the major fixed platform contracts that were awarded in the first half of the year, and that would include Petro Vietnam's Block B project, as well as ONGC's Diamond Development offshore India. So overall, in the first half of the year, we have recorded just about 19 fixed platforms that were contracted during that time period. And when you're looking at the second half of the year, we are looking at major projects like Qatar Energy's North Field Compression Development, as well as ADNOC's Zakum, as well as the Saif project offshore the UAE. So the fixed platform project continue to dominate activities in the Middle East as well as Southeast Asia, while subsea development as well as the floating production systems dominate the Americas as well as West Africa. Next slide, please. So when you're looking at subsea tree demand, right here, what we currently anticipate post 2024 is an average of about 280, 290 units year on year. So right now we currently see 2025 to close at just over 300 subsea tree units. However, there are potential for certain project delays, especially when you are looking at some of the high capex project offshore West Africa, specifically when you're also looking at some project offshore Namibia, with Total Energies Venus project being the next one, or being the first mover in that particular country to move forward. We currently record that project to likely go ahead late 2025 or early 2026. So there are probabilities for back and forth swings when you're looking at the subsea tree demand over the forecast period. When you look at the rest of 2024 as well, we are looking at Total Energies Block 58 as one of those major projects that could more or less help us sustain that current forecast, which 58% of you all that did the survey kind of agreed to. But there are also some downward risk. We've seen the likes of the Bonga North Development offshore Nigeria, which is a project that we've been tracking for a couple of years now for FID, but that continues to experience delay. We also see the Pecan project offshore Ghana is one of those projects that is still expected to move ahead in the second half of this year, but is currently more or less still in the evaluation phase as well. ENI's Coral North Development offshore Mozambique is another major project that we are tracking for the rest of this year to support the subsea tree demand that we have into H 2024. But overall, not being surprised there for us to have Petrobras as one of the leading operators for the subsea tree demand through to 2027. And at this point, I'd like to highlight that in the first half of the year, we only recorded 5 subsea tree awards for Petrobras. However, in the second half of the year, we expect that the Brazilian NOC is going to account for about 50 units of the subsea tree demand in the second half of 2024. And that would be related to the Atapo Phase 2 and Sepia Phase 2 project, whilst redevelopment project or revitalization project in the Santos and Campos Basin would also drive the subsea tree demand. And that is more or less different from the recently launched 82 subsea tree demand from Petrobras, which is expected to be awarded under a frame agreement with interested contractors expected to submit commercial bids by October this year. Next slide, please. So what I would like to show right here is just the spatial distribution of the subsea tree demand through to the first quarter of 2027. And you can see predominantly that the golden triangle of North America, the US Gulf of Mexico, Latin America, as well as West Africa continues to drive the demand for subsea trees. Overall, very large subsea development are concentrated in Latin America, with ExxonMobil's Hammerhead as well as Longtail, more or less, I would say, project to highlight. Right now, we currently anticipate the Hammerhead project is going to be sanctioned in 2026, which more or less gives a lull to the trend in which Exxon has actually established over the last few years by sanctioning at least one major project offshore Guyana. Also, outside Petrobras's investment, you can also see that we are tracking Shell's Gato do Mato project offshore Brazil. However, this project has been delayed for a couple of years, but we anticipate this will move forward in 2025. Offshore Nigeria, you're looking at the Preowei project as well as Exxon's Owowo project as one of those major projects that could really turn around the production profile offshore Nigeria in the medium term. You can see right there in the North Sea and offshore Norway, you can see quite a number of projects that we're currently tracking, which includes the Slagogo project as well as the Fram Sol, which One Subsea Alliance was awarded a FEED contract for the all-electric subsea tree earlier this year. When you look at Southeast Asia, quite a number of small developments are currently being tracked there, and including ENI's Geng North, which we anticipate is going to be sanctioned in the first half of 2025 as well, while Ichthys Phase 2C is another project that we're tracking for second half of 2024. Next slide, please. So a quick roundup when we are looking at the subsea market is more or less an indication of the cost inflation that we're seeing in the marketplace today. Right now, we currently anticipate about 20% increase on the average subsea tree spend per FID when you compare 2022 to 2023, 2024. We've more or less combined the 2023, 2024 because a number of tenders that were submitted last year were not awarded. Hence, there's always a few contracts that actually straddle a couple of years. And that's one of the reasons why we've combined that overall. But what you can actually see here is like for like cost increase overall since 2020, which was the peak of the COVID pandemic. Next slide, please. So a quick jumping into the floating production systems market. So over the next 5 years, we're currently tracking 65 units to be awarded with an EPC award value of 98 billion. Of the unawarded units, we currently anticipate 12 of those to be firm, which means they are expected to be sanctioned within the time frame stipulated with an EPC award value of 23 billion. Year to date, we've actually tracked 8 units that have been sanctioned, with another 5 expected to be sanctioned as firm this year. And that would include the likes of the Cascada project. At the time of putting together this slide, the FID was yet to be confirmed, but we believe that is going to go ahead, with Citrum already issued a letter of intent earlier this year, while the likes of Coral North FLNG unit is another project that we believe is firm for 2024. So overall, our 2024 outlook for FPS spend is 28.3 billion. And if you look at the chart on the right-hand side, the super majors will continue to dominate the demand and the spend around your floating production systems. So overall, Exxon's commitment to the Stabroek block offshore Guyana is one of the main reasons we are seeing that continuous growth, while ENI's Berlin, Coral North, as well as the Gangnot project is also contributing to that growth. When you are looking at the NOCs, this is predominantly driven by Petrobras's activities offshore Brazil, and we can see quite a number of those projects to be marked as sanctioned when you're looking at the value. Predominantly, that is the 8.1 billion that was allocated to the P84 and P85 units earlier this year. But overall, we continue to see a relatively stable market for the FPS outlook. When you compare that to the subsea market, is more or less a like-for-like comparison. So what we've seen in recent years is operators are beginning to develop some of the standalone projects in comparison to the 2021-2022 period, where operators opted for subsea tieback to utilize existing capacity on existing infrastructures within certain blocks around the world. Next slide, please. So here is just a quick note on the capacity, FPS capacity sanctioned. And what we've done here is to group this on a 5-year timescale. So between 2014 and 2018, you can see overall 3.4 million barrels of oil equivalent per day was sanctioned during that time period. If you compare that directly to the 2024-2028 period, that is more than doubled, because we are currently expecting 8.4 million barrels of oil equivalent of capacity, FPS capacity, to be sanctioned over that time period. And all of the expenditure all of the capacity additions or sanction that you can see over the 2019-2023 period is more or less what is reflecting those production growth that Ben showed in a few slides earlier during the presentation. But what you can also see here in the pie chart is the Latin American region continue to dominate the capacity, as against the position when you look at the 2014-2018 period. During that time period, the region was only accounting for 37% However, when you skip forward through to the 2019-2023 period, or if you look further to the 2024-2028 period, the region is definitely accounting for well over 60% of FPS throughput capacity that is sanctioned or that is expected to be sanctioned. Next slide, please. So a quick one as well on the cost inflation that we're seeing within the floating production market as well. Obviously, it's no news anymore in terms of shipyard capacity, and that is definitely having an impact on the cost per throughput or the average cost per throughput for new build as well as converted FPS units. So overall, one of the I'll say trends I would like to point out here is whenever you see the cost per throughput rise beyond $10 per throughput capacity, you can see there is a corresponding increase in the number of FPS units that are being sanctioned as upgrades. So operators start to become a little bit much more creative in using existing infrastructure, redeploying existing FPS units, while in some cases they might still have to take those units to the shipyard for slight upgrades before they are being redeployed. So for example, a case in point is going to be Equinor's Rosebank development offshore UK, where this development has now progressed based on the fact that the operator opted to upgrade and redeploy an existing unit. Another case in point is going to be Santos's Dorado project offshore Australia. So over the years, the operator has been considering a converted unit to be deployed on that field. However, in a ploy to reduce the upfront capex for that particular project, they've actually they are more or less re-entering FEED now to be able to consider the deployment of an existing unit. Obviously, when you look at other independents as well, so you're looking at projects offshore the Falklands like the Sea Lion, operators are beginning to embrace the redeployment of those existing units. And I think at the moment, if you look at our data, we have barely 5 leased units that are still out of contract and that could potentially now be redeployed or have been earmarked for redeployment in terms of future development. Also, a case in point recently, if you look at the Berlin development, phase 1 and phase 2, these are projects that more or less move forward by the use of redeployment. So operators are more or less being currently forced to go via conversions or new builds because the options of redeployment or units available for redeployment is actually dwindling. And that in the case might mean that these inflationary pressures that we're currently seeing in the FPS marketplace could be extended beyond 2024. Next slide, please. So just to round off a little bit on a very positive note, even though the forecast is relatively stable when you look at the supply-demand balance, when you look at production addition, as well as when you're looking at the EPC award value for subsea equipment, as well as floating production system. However, we would like to also mention that there's been a number of recent discoveries, especially offshore Namibia, offshore Guyana, and in other basins as well. So offshore Egypt, you can see, as well as offshore Colombia, you can see some gas discoveries there as well. However, these discoveries are not yet included in our forecast, which then means they represent potential upside. So if we see early movers for the likes of the Mopane field offshore Namibia, whether a quick early production system is being deployed for that particular field, that would definitely bring potential upside to some of our subsea tree demand outlook, as well as floating production systems. However, I'd like to point out in terms of gas development, historically, some of these projects do experience significant delays. So for example, we've seen Total Energies walk away from the Luped and the Brupada project offshore South Africa because they could not come to physical terms on how to develop those projects economically just for local consumption as well. So if local requirement does not give room for the possibility to export those the gas reserves, either by LNG or FLNG units, that could mean that some of those projects could be hanging around for a little bit longer. Next slide, please. So just to round off quickly, oil prices have traded above $80 through the first half of this year. And we believe that that has been achieved, or that has been underpinned by the OPEC Plus voluntary output cuts during that time period, which helped to more or less keep the market undersupplied in the first half of the year. However, as Ben mentioned earlier, OPEC is now looking to add those production back starting from September this year, which then means that there is a possibility that supply could outstrip demand in the second half of the decade. However, if that scenario plays out, we believe that OPEC will continue to intervene in the market to ensure that oil prices more or less trade at between $70 to $90 per barrel, which would help meet some of their local budgetary requirements. Also, when you're looking at the offshore EPC spend this year, we anticipate $61 billion, of which 50% as of the midway of the year has been awarded. And over the 2025-2028 period, we anticipate another 51 billion year on year on average is going to be awarded. It's also good to highlight at this point that our assumption is underlined by oil prices averaging $75 to $85 per barrel in 2024, whilst oil prices should trade above $70 per barrel between 2025 and 2028 for that forecast to become a reality. Supply chain inflationary pressures continues to be a source of concern, and this could mean that projects could continue to experience significant delays or cancellation as E&Ps want to continue to stick within their budgetary allocation. But overall, it's a relatively stable forecast, and there are potential upsides due to some of the recent discoveries that have been made offshore Guyana, Namibia, as well as in the East Med. That said, I will pass over to Gareth while we go through some of the questions.
Thank you, Mark and Ben. That's some great insight there. Like I say, it's been a while since we've run this topic on a webinar. So there's a lot to cram in what you've done 35 minutes. So great job. I think there's a couple of questions that have come through. I think we've got time for a few of them. Just whilst you're having a look at those, for those people that are still with us, in the chat box, you'll see I've put a couple of links to the products that this insight has been generated from, the apps that we use and that the guys lead, as well as the events email. So if you're unable to stay on beyond now, feel free to submit any questions to that email address, as we say. Mark.
Yep, I'll take the first one here, which is offshore rigs viewed as a bottleneck. At this point in time, we understand that utilization for various offshore rig type is quite high, on average, well within the 90% mark. But right now, we don't currently see it as a bottleneck, also because there is a longer lead time for the delivery of some of those required subsea equipment. So on average, previously, you will see subsea trees being delivered within 18 to 24 months, depending on the project size. But that time period has more or less moved on more or less into the 36 months period. However, with the I would say lower than expected subsea tree award count so far this year, as well as for the second half of the year, we want to believe that capacity constraints might start to ease up. Also, when you're looking at it from a floating production system side of things, because operators are beginning to look more into the redeployment of existing units, that means that time to FID could relatively be short, because the time in which you use in upgrading those FPS units in comparison to a conversion or a new build will be definitely shorter. I think the next question, I'll pose this to Ben, and it says here, how do you see the growth in renewable energy affecting the demand for hydrocarbon?
A very big question. That one, we could probably do a whole webinar on that. Unquestionably affecting it. I think when we talk about the plateauing demand, part of that is a result of over 2026 to 2030. Part of that is a result of renewables coming into the market, as well as things like extra gas supply. I think really it's when we talk beyond 2030, that's when the picture changes. Certainly 2030 to 2040 is is going to be the decade, I think, where we see how much impact that has. If you look at someone like BP, their recent kind of energy outlook had, I can't remember the figures off the top of my head, but essentially liquids demand dropping quite rapidly at that point, with a lot of that coming from EV vehicles, electric vehicles, taking away that liquids requirement for cars and things like that. So I'd say through to 2030, the effects are going to be relatively limited. Beyond that, obviously, no one knows for sure, but it looks like it will definitely have an impact, and we'll be getting into that point where oil's on a steady decline, I think is probably the consensus view at the moment.
Thank you, Ben. I think that's all the questions we currently have. I think another one, I'll just answer that verbally as well. Our deep water, shallow water split would be shallow water is going to be 250 meters of water, while deep water, ultra deep water, starts from 250 upwards. So over to you, Gareth. Thank you.
Great, thanks. Like I say, if anyone wants to have a one-to-one or any questions that you'd rather speak directly, please use the events@westwoodenergy.com email address, and we will get back to you afterwards. Alex, can I invite you just to join the call?
Yep.
Super. So we've got about 10 minutes or so left. So we're just going to hand over to Alex to go through SubseaLogix and PlatformLogix. Like I say, if you have any more questions, you can continue to put them in the Q&A. As long as you put your name there, we can follow up with you directly afterwards as well. Alex, with you.
Thanks, Gareth. Yeah, hi everyone. Good morning, good afternoon, good evening. I'm Alex Axelberg. I'm one of the business development managers here at Westwood, focusing on our offshore market intelligence services, two of which are SubseaLogix and PlatformLogix. So SubseaLogix and PlatformLogix are Westwood's market intelligence services for the offshore infrastructure sector, where we focus on subsea components as well as fixed and floating production systems, respectively. The tools will also include global field developments, as well as various work scopes around the world in terms of awards and tenders. So you can see there's a series of tabs down the left-hand side. There's three universal tabs that umbrella both SubseaLogix and PlatformLogix, and I'll just work top to bottom. You can see there's individual tools inside both Subsea and PlatformLogix that are unique to those tools. So the first tab is Daily Logic. So that's what I'm currently showing on my screen right now. That refers to the daily insights that we provide our users with in real time, published in chronological order. You can understand the narrative of the market. You can use these filter functionalities on the left-hand side here to specify a country, a timeline of when it was published, a field, a platform, also activity type. This ranges from many, many things, from contract announcements to IRM activities, decommissioning, etc. To take the example of contract announcements, we just select that, and then we'll have only publications under that topic. You'll also see there's tags under the articles as well. So you can either click on these tags and refilter on those topics, or indeed you can go directly in to the field profile itself. So for every field, we have a full profile where we combine all the information on that field into one page. So I've clicked on the Camino field. We've got the daily logics down the right-hand side. We've got a timeline of the various milestones of the project. We have the development details, also location, a summary of what's facilitating the field. We provide information on what is actually spent on the subsea components. We provide a roundup of all the contracts and work scopes that have happened on that field or will happen on that field, as well as a summary of all the subsea equipment that will be installed on the field or has been installed on the field, how much that costs, who buy, etc. And then we finally have any applicable fixed or floating production systems associated with that field. The next tab down is the fields data. So this is the data directory for all global offshore field developments. Predominantly will be upstream, but we do also capture midstream and CCS projects here as well. use the same kind of filters to specify your search. You can click directly into the project profiles via the hyperlinks as done on the previous slide, previous page, sorry. And then of course you can filter on the status, the sanctioning probability, location. If we take, for example, Norway as an example, just to see all the projects in Norway, we can also filter on the timelines when they're passing FID, etc. And then we have a mapping functionality of all these projects as well, that you can click through to and interact with. The final universal slide is the contracts database. So like I mentioned, this is where we track all the work scopes and work scope areas. So lots to choose from. You can also track the bidders and winners of these individual contracts. To give you an example, we can select the work scope area of SURF, click on EPC, and then we have a range to choose from here. We can click through to the profile, and then we'll have a profile page of that contract with all the necessary information, including running commentary of daily logics down the right-hand side, as well as a list of those who bidded on this contract and indeed the winner. Going down into SubseaLogix specifically, we have something called market analytics. So this is a visualization of the size of the market, either by expenditure or by volume of equipment. So if I click on the equipment to just understand the volume of the market, we'll be greeted with a dashboard across a timeline looking at all the regions. You can select from 3 groups of equipment. So currently we're on subsea production equipment, but we can select SURF or pipelines if we want to. We can specify the timeline as well if we pick 2023. You'll see the charts underneath will act according to that. It's been pre-selected on the trees already. So let's look at that. And then we can decide, or then we can see, first of all, who's in the leaderboard in terms of operator and in terms of country. So if we were to click on Equinor, that'll reduce down to just those countries applicable. If we want to see the data that's driving these charts, we click on Show Data, and that will take us through to the components data directory where we can see all those components individually, line by line. Again, we can click through to the projects themselves. We can use the filters to specify our search further, and you can save any of these reports into the system so you don't have to apply these filters again. You can export it, and you can also manage the columns to delete any columns that aren't of interest and add in any additional ones that may be. To give you an example of how this can be used, for example, if we want to understand the market share of a particular manufacturer, say we take Technip FMC as an example, and we want to know how many trees were ordered from them in 2023. All we have to do is click on component type and type in tree. We then change the component order date. So we select the 1st of January in 2023. And then our end date would be 31st of December, 2023. We then type in Technip FMC as the manufacturer, show results, and then you can see line by line everything that was ordered in 2023 from Technip FMC. And then you can see the projects, when they were ordered, and what the development structure of those projects were. Going down to PlatformLogix, PlatformLogix also has its own market analytics feature, which works in the exact same fashion. You can specify whether you want to look at the volume or you want to look at the spend. If we just want to look at the FPSO market, we can narrow that down like this. We can also decide on the hull type, and we can, of course, select a time, a period on that timeline. If we select 2023 again, we can see by FPS operator who's in the forefront for that year, and also the same in terms of country. Click on Show Data, and then line by line, we have a list of all of those FPSOs that meet that category. If I reset this, again, to give you an example of how this data can be used, if you're looking for FPSO availability and you want more information on the contract type, or contract end date, so if they're leased, what is the optional expiry date of the contract, and what is the fixed expiry date of the contract. What we can do is go to FPSO. We need to ensure that we are just looking at the leased FPSOs, and then we can select status and select installed and operational, and then we'll get those results. But what we want to do is, although we have the available dates, we can go to manage columns, and then we can add in some additional necessary columns to get those additional dates. And then just for the sake of neatness, we can move these up in line with the other dates that we see on the data. So now we have that information nicely together, and we can export that as it is into Excel or save it into the system. Note that the market analytics only refers to the floating market. We have a separate database for the fixed platforms market. So if we click on that bottom tab here, we then get the same format. We get a list of all the fixed platforms. Now, all the platforms also have their own, profile. So just to show you what that looks like. So just like the fields data, you can also look at these on the profile too. So if we take the toll amount as an example, we've got the field it's attached to, so we can click on that. We have a designated daily logics down the right-hand side. We have a timeline of the milestones concerning this platform. We've got the contractor information, development details, location information. You'll also notice there's an empty box here that says electrifications. So that was the next point I just wanted to bring up. Although not applicable to this platform, we do also provide information on the electrification on all the platforms. If you wanted to see the platforms applicable to that, just go to the filters, scroll down to the bottom, click yes on electrifications, and then you get a list of everything that's applicable. We scroll to the right of the screen. You can see it's got a tick under electrification, as well as some information on when this is going to be electrified. We do also provide additional notes on the profiles themselves of the electrification. Is it from an onshore plant? Is it wind turbines? And under electrifications here, you'll be able to see exactly what that means per platform. The last thing I just wanted to touch on, as we've got a few minutes left, you will also, as a subscriber, have access to our library. So within a subscription for both SubseaLogix and PlatformLogix individually, you'll have access to our quarterly reports. I'll just share an example on the screen now. We won't have time to go into the full detail of the report, but this is the Subsea Equipment Market Report of Q1 of this year. And the content will remain relatively consistent from quarter to quarter, providing an industry overview of the state of the market, looking at supply and demand, doing a roundup of the contracts, as well as looking at the OEM performance, and then followed by an outlook per equipment group and then per region. So it will use some similar sort of visualizations that you saw in the presentation today. So if you have any questions on either the report or the system, please get in touch. But that's all from me, and thank you very much, everybody, for your time.
Thanks, Alex. Always a challenge to get that much information, as with Mark and Ben, in a short space of time. To those that are still with us, thank you very much for hanging on. Hopefully you found that useful and informative. As I said before, we will be in touch with a recording available to you. There's links in the chat there for each of the products that Alex has just referred to, as well as the email address to get in touch with us all. As I said also before, we are available for one-to-one chats if that would be productive for you. That's it for today. That's our second session done for today. Team, thanks very much. Brilliant as always. And wish you a good rest of your day. Take care. Bye-bye.
Thank you. Bye.